You were never supposed to find out about this the way you're finding out right now. Not from a government letter, not from your local Social Security office, and certainly not from the nightly news, because the people responsible for managing your retirement money, the money you spent your entire working life paying into, decided that burying this information in fine print and federal jargon was good enough. Well, it's not good enough. Not for you. Not for the millions of Americans who built this country with their hands, their time, and their sacrifice. And definitely not right now, because what just changed inside the Social Security system, starting May 1st, is something every single retiree in America needs to understand before their next check arrives. Let me be straight with you. I'm not here to scare you. I'm not here to twist the truth or make you panic over something that doesn't matter. What I am here to do is lay out exactly what happened, why it matters to your monthly income, and what you need to do about it starting today. Because the difference between the people who protect their retirement and the people who slowly watch it disappear almost always comes down to one thing: information, not luck, not connections, not having a financial advisor on speed dial, just knowing what's actually going on and acting before it's too late. So here's what we're going to cover. We're going to talk about the cost of living adjustment that officially hit your May payment, and why the number they gave you might actually be working against you when you factor in everything else. We're going to talk about a historic change to two provisions that have been quietly stealing money from public sector retirees for decades, and why May is the month where that finally starts to reverse. We're going to talk about Medicare premiums that are silently eating into your Social Security check right now, and a little-known appeal process that could save you hundreds of dollars a month that most people have no idea even exists. And we're going to talk about the earnings limit, the tax trap, and the exact steps you need to take this week to make sure the government isn't keeping money that belongs to you. But first, let's talk about what actually happened with the cost of living adjustment, because I think there's a major disconnect between what people were told and what people are actually experiencing. The Social Security Administration announced a 2.5% cost of living adjustment for 2025. On paper, that sounds like you're getting a raise. And technically, you are. For the average retiree, that works out to roughly an extra $50 per month. Over a year, that's $600. If you and your spouse both collect Social Security, you could be looking at $200 or more combined. And yes, that money is now officially reflected in your May payment. So if you haven't checked your deposit amount recently, you need to do that today, not tomorrow. Today, because here's where the disconnect starts. That 2.5% was calculated based on something called the Consumer Price Index. It's the government's way of measuring how much everyday goods and services cost. And in theory, the cost of living adjustment is supposed to keep your Social Security benefit in line with inflation. It's supposed to make sure that as prices go up, your income goes up with them. But let me ask you something. Does your grocery bill feel like it only went up 2.5%? Does your electric bill feel like it only went up 2.5%? When you fill up your tank or pay for a prescription or look at what your insurance costs this year compared to last year, does any of it feel like 2.5% covers the difference? For most people, the answer is no. And that's not just a feeling, it's math. Because the Consumer Price Index measures a broad basket of goods and services across the entire economy. But retirees don't spend money the same way a 35-year-old does. Retirees spend more on health care. They spend more on housing. They spend more on the exact categories that have seen the sharpest price increases over the past 3 years. So while 2.5% might reflect the general economy, it doesn't reflect your economy. It doesn't reflect the reality of trying to live on a fixed income in a country where everything keeps getting more expensive. Now, I want to be clear, I'm not telling you this to make you feel hopeless. I'm telling you this because understanding the gap between what the government says inflation is and what you're actually experiencing is the first step toward making smarter decisions with the money you do have. That $50 a month matters. That $600 a year matters, but only if you're not losing it somewhere else without realizing it. And that brings me to the part of this that most people don't even know about, the part that could mean the difference between getting by and actually getting ahead. Because while everyone was focused on the COLA number, something much bigger was happening behind the scenes. Something that affects a very specific group of Americans who have been getting shortchanged by the Social Security system for years. And if you worked in the public sector at any point in your career, or if your spouse did, what I'm about to explain next could put thousands of dollars back into your hands. Real money, money you already earned, money that was taken from you under rules that were never fair to begin with. Stay with me. We're just getting started. For decades, there were two provisions buried inside the Social Security system that most Americans never heard of until it was too late. The windfall elimination provision and the government pension offset. If those names mean nothing to you, consider yourself lucky, because for the people who were affected by them, these two rules were responsible for slashing hundreds of dollars from their monthly social. Security checks, sometimes more, year after year after year. Let me explain how this worked, because it's important that you understand just how unfair this system was. Let's say you spent 25 years working as a teacher in a public school district. During that time, your employer didn't pay into Social Security. Instead, you were part of a state pension plan. But before you became a teacher, or maybe on the side during summers and weekends, you also worked jobs that did pay into Social Security. You put in your time, you paid your taxes, you earned your credits, and when you finally retired, you expected to collect your pension and your Social Security benefit because you earned both of them separately with separate work. But the government didn't see it that way. Under the windfall elimination provision, the Social Security Administration reduced your Social Security benefit because they said you were double dipping. They used a modified formula to calculate your benefit that could reduce it by hundreds of dollars per month. Not because you did anything wrong, not because you cheated the system, but because you happened to work a public sector job that had its own pension plan. Teachers got hit by this, firefighters got hit by this, police officers, postal workers, state and municipal employees across the country. People who served their communities for decades were penalized for it when they retired, and it got worse. The government pension offset was even more aggressive. If your spouse worked in the private sector and paid into Social Security, and you were entitled to a spousal benefit based on their record, the government pension offset could reduce or completely eliminate that spousal benefit. We're talking about surviving spouses, people who lost their husbands or wives being told they couldn't receive the survivor benefit their spouse earned because they themselves had a government pension. Think about that for a moment. A widow who spent 30 years teaching children in a classroom, whose husband worked in construction and paid into Social Security his entire life, could be told she gets nothing from his record, not reduced, nothing because of a rule that treated public service like a disqualification. This was the reality for roughly 3.22 million Americans, and for most of them, there was nothing they could do about it. They wrote letters, they called their representatives, they joined advocacy groups and fought for change, and for years nothing happened until now. The Social Security Fairness Act was signed into law, and it eliminates both the windfall elimination provision and the government pension offset entirely. Not reduced, not modified, eliminated, gone. And what that means in real terms is that millions of Americans who have been receiving artificially reduced Social Security benefits are now entitled to their full benefit amount, the amount they should have been receiving all along. But here's the part that makes May so critical. The Social Security Administration has been working through the process of recalculating benefits and processing retroactive payments for everyone affected. And May is when a significant wave of those adjustments are expected to hit. Some people are going to see their monthly check increase by $200, some by $400, some by even more, depending on how severely their benefit was reduced and how long they were affected. And then there are the retroactive payments if you were underpaid for months or even years. because of the windfall elimination provision or the government pension offset, the Social Security Administration owes you that money. Back payments, lump sums, real dollars that were withheld from you under rules that no longer exist. Some people are looking at retroactive payments of $5,000. Some are looking at significantly more than that. It depends on your individual situation, your work history, your benefit calculation, and how long these provisions were applied to your account. Now, here's what concerns me. I know for a fact that there are people watching this right now who are affected by this change and don't even know it. They never understood why their Social Security check was lower than they expected. They just assumed that's how the math worked out. They accepted the number on their statement and never questioned it because the system made them feel like questioning it wasn't an option. I need you to hear me on this. Questioning it is absolutely an option. It has always been an option. And right now, with these provisions eliminated, it is more important than ever that you look at your benefit with fresh eyes and make sure you're receiving every dollar you're entitled to. If you worked in any public sector role at any point in your career where your employer did not pay Social Security taxes, you need to take action. If your spouse worked in such a role, you need to take action. If you are a surviving spouse and your benefit was reduced or eliminated because of the government pension offset, you need to take action. The Social Security Administration is processing these changes, but they are dealing with millions of cases. And the people who contact them, the people who call and verify and follow up, are the ones who get their money first. I'm going to give you the exact steps to take later in this video. The phone numbers, the websites, the forms, everything you need. But right now, I want to make sure you understand just how significant this moment is, because for 3.2 million Americans, May 2025 isn't just another month. It's the month the government finally starts giving back what it should never have taken in the first place. And we're not done yet. Because even if the windfall elimination provision and government pension offset don't apply to you, there is another change hitting your May check that you absolutely need to understand. And this one affects almost everyone on Social Security. Let's talk about the thing that's quietly eating your Social Security check every single month and getting worse every single year. Medicare, specifically Medicare Part B, because this is where I see people losing money. They don't even realize they're losing. And it drives me crazy because most of it is preventable if you just know what to look for. Here's how it works. For most retirees, your Medicare Part B premium is deducted directly from your Social Security payment. You never see that money. It's gone before your check ever hits your bank account. And in 2025, the standard Medicare Part B premium increased to $185 per month. That's up from $174.70 in 2024. So right there, you're paying an extra $10-30 every single month just for the standard premium. Over a year, that's an additional $123.60 coming out of your Social Security income. Now remember that 2.5% cost of living adjustment we talked about earlier, the one that was supposed to help your benefit keep up with inflation. For the average retiree, that COLA added roughly $50 per month. But Medicare just took back about 10 of those dollars before you even saw them. So your real increase, the money that actually ends up in your pocket, is closer to $40. And that's only if you're paying the standard premium, because here's where it gets significantly worse for a lot of people. And this is the part that most retirees don't fully understand until it's already costing them serious money. There's something called IRMA, the Income-Related Monthly Adjustment Amount. It's basically a surcharge on top of your standard Medicare premium that kicks in if your income exceeds certain thresholds. And the word income here is doing a lot of heavy lifting, because the government doesn't just look at what you're earning right now. They look at your modified, adjusted gross income from 2 years ago. So for 2025, they're basing your ERAA determination on your 2023 tax return. And if your income in 2023 was above $16,000 as an individual or $212,000 as a married couple filing jointly, You are paying more than the standard premium, sometimes a lot more. At the highest income brackets, your Medicare Part B premium can exceed $600 per month. That's more than $7,200 per year, coming directly out of your Social Security benefit for Medicare alone. And a lot of people get caught in this trap, not because they're wealthy, but because they had a one-time financial event in 2023. Maybe they sold a property. Maybe they took a large distribution from a retirement account. Maybe they had capital gains from selling investments. One good year on paper, and suddenly Medicare treats you like you're rolling in money for the next 2 years. But here's what almost nobody tells you. You can appeal your IRMA determination. If your income has dropped significantly since 2023, if you've retired, if you've stopped working, if you've experienced a divorce, the death of a spouse, or any other qualifying life-changing event, you can file what's called a life-changing event appeal and potentially get your premium reduced back to the standard amount or close to it. The form you need is SSA 44. You can download it from ssa.gov or pick it up at your local Social Security office. You fill it out, you provide documentation of the change in your income, and you submit it for review. I have talked to people who were paying $400 a month for Medicare Part B, filed this appeal, and got it reduced back to $185. That's a savings of $215 per month. That's $2,580 per year back in their pocket. Real money, life-changing money for someone on a fixed income. And they almost didn't file because they assumed the number on their statement was final. They thought if the government said they owed that much, then that was just the way it was. It's not. The government makes mistakes. The government uses outdated information. And you have every right to challenge a determination that doesn't reflect your current financial reality. So if you're paying more than $185 per month for Medicare Part B, I want you to stop right now and think about whether your income has changed since 2023. If it has, you may be overpaying, and you don't have to accept that. Now let me shift to something that affects a completely different group of retirees, but is just as important. If you're collecting Social Security benefits and you're still working either part-time or full-time, there's an earnings limit you need to know about. And the numbers changed for 2025. If you are under your full retirement age for the entire year, you can earn up to $22,320 without any reduction in your Social Security benefits.